When Novo Nordisk released its Q1 earnings report, the institutional response was immediate. Shares jumped 7% in Copenhagen. This chart shows exactly why. Look at the Jefferies consensus estimate for the newly launched Wegovy pill, 1.16 billion Danish kroner. Now look at Novo's reported actuals, 2.26 billion kroner, or about $354 million US, driven by 1.3 million prescriptions. That is a 94.8% variance. They nearly double the consensus estimate on a large-cap biopharma product in its very first reporting quarter. A miss of this magnitude does not happen because of a rounding error or an unexpected tax benefit. It happens because the market's underlying model for patient adoption was systematically flawed. Analysts looked at the new oral obesity market and completely misjudged 3 distinct mechanical variables, leading to the massive discrepancy we see in the Q1 data. First, they assumed introducing a pill would automatically cannibalize sales of the existing injectable, blinding them to actual total addressable market expansion. Second, they severely discounted the compounding advantage of an incumbent holding a monopoly. And third, they ignored the mathematical reality of the dose titration schedule, missing a massive revenue lag built right into the clinical guidelines. Understanding where these institutional models broke down is the only way to accurately price the $250 billion future of the obesity care sector. Heading into Q1, investors feared format cannibalization. They assumed a highly convenient oral pill would automatically consume the market share of the incumbent injectable. This Sankey diagram illustrates Wall Street's hypothesis: millions of patients dropping injectable prescriptions to take the pill, draining one bucket to fill another. Q1 data shattered that. Wegovy injectable revenue didn't shrink. It grew 12%, hitting 18.2 billion kroner. The legacy injectable format held its ground entirely. When asked directly about cannibalization, Novo CEO Mike Doustdar told CNBC that the pill is having a purely synergetic effect on the franchise. This forces a critical question. If the 1.3 million patients taking the new pill didn't transfer from the injectable pool, where did they come from? They came from the sidelines. The oral format unlocked a demographic previously deterred by needle phobia, cold chain storage limits, or the higher out-of-pocket costs of injectables. This stacked area graph illustrates pure TAM expansion. The pill layers new demand directly on top of the established injectable baseline. Because of this additive effect, Novo's total Wegovy franchise is structurally larger today than before the pill launched. Novo executed a textbook strategy to grow their total clinical footprint, turning a perceived vulnerability into aggregate growth. By treating the oral launch as a simple format swap, financial models entirely missed the activation of a massive, previously dormant patient population. The secondary failure of these models was underestimating the strength of Novo's offensive position against their primary competitor, Eli Lilly. This pie chart reveals a commanding metric. Wegovy captures 65% of new U.S. prescriptions. This self-reinforcing flywheel, where prescriptions generate physician familiarity, telehealth integration, and word of mouth, rapidly looped back into 200,000 weekly scripts before competitors even entered. Eli Lilly finally mounted their counteroffensive in early April with the launch of their own oral GLP-1, Foundayo. The asymmetry between the two forces was immediately clear. In its second full week, Foundayo logged just 3,707 prescriptions against Wegovy's 200,000. For Lilly's leadership, the strategic dilemma is how to break